Thanks for taking the time to come on the show. We want to begin this morning with the move lower that we saw in the peso yesterday. It came in reaction to the resignation of the finance minister, who had some choice words on his way out the door. Did you see he tweeted his resignation letter?
I did. No, I did, and you know, it was probably a little bit of an overreaction in the marketplace,
Yeah.
which is not atypical of what we would see on an unannounced announcement, right? We didn't know that this was coming. Probably a little bit of an overreaction. Nonetheless, you know, there was some hostility, you could say, upon his resignation.
Scott, it wasn't just the peso yesterday. The British pound saw a new low for the year, and well, you can understand why. I mean, there's been not much progress on the Brexit front that I've been hearing. I'm wondering if you've heard any, because it seems like the focus has really been, and all the energy has been finding and trying to replace Theresa May.
It's really unbelievable how it has gone from, you know, just a month ago, 6 weeks ago, of the forefront of the news and what's going to happen. And now, you know, you've got to skim through every well, I'm an old guy, so I still read the newspaper, but you've got to skim through, you know, all the news you can find to even see, you know, something about Brexit right now. So you're right. The focus really has, you know, just kind of shifted towards a replacement. It's taken a back seat right now, but that has really taken its toll on the pound.
It has, and all of this, Scott's helping support the U.S. dollar and feeding into the narrative that you and I have discussed multiple times on the show. Negative rates in Europe, a weak pound, a weak euro as Brexit, and some of the data out of the EU continues to disappoint. So what should dollar traders be looking for in terms of support from the Fed today? I mean, would it be a hint of one or not two, or possibly some sign that the July cut is more of an attempt to roll back that DC rate cut, or rate hike, I'm sorry, as rate cuts are not necessarily the new norm? I mean, would that support the dollar at this point?
It really would. And here's what's unbelievable, Ben. Over the last week, literally 1 week, and now this is changing as we speak based on Powell's comments right now. Literally 1 week ago, July 3rd, 29%, the CME Fed Market Watch tool was pricing in a 29% chance of a 50 basis point cut, 71% chance of 25. So 100% chance that we're going to get a cut. As of literally about 20 minutes ago, before Powell's comments just came out, a 0% chance of a 50 basis point cut.
Interesting.
96% chance of a 25 basis point cut, and even a 4% chance of no cut. So this is such a fluid marketplace, and this is such a fluid situation here, and it's going to be really interesting to see what his comments are later. Yes, like you said, these were the prepared remarks that just came out that made the markets rally here. Treasuries rally, yields come down a little bit. It's going to be really interesting here to see what happens.
Yeah, you know, Scott, I mean, in some ways, I'm glad you brought that up, because that makes a lot of sense considering how fluid some of the economic data has been, and especially the flow in terms of what we saw Friday, the jobs data. I mean, that was significantly stronger than expected. You can see how that would kind of take the Fed's dovish approach back a notch at least.
No doubt about it. And, you know, we've got wholesale inventories. We've got a lot of other economic reports leading up to that July 31st, you know, announcement that could really make or break what this move is going to be. Now,
PPI
in terms of what they're going to do to combat maybe what the rate hike back in December, it certainly looks like, and I'm not going to say the appropriate thing, because I think the appropriate thing is not to do anything. But it certainly looks like the 25 basis point cut is kind of the Goldilocks scenario, if you will. However, I truly believe that we're going to see some rhetoric that he says, you know what, we have to look at this information. We have to look at these reports. Things are weakening a bit, but I don't think that 3 rate cuts for the rest of this year is a certainty whatsoever. In fact, I think 2 is very questionable.
Yeah, you're not alone, Scott. I mean, we're watching treasuries come off recent lows, but it's not just the Fed that we're focused on today. Bank of Canada this morning in about an hour and a half. I think they're expected to leave rates unchanged. What do you expect to see there?
I see that as well, and here's another situation, a fluid situation, that rates there, and the Canadian economy is actually doing probably as well as any economy in the world right now. That's why they are not pressured to relieve. They are not pressured to lower rates. They're the ones that are probably going to stand pat. The divergence between the U.S. and Canadian rates U.S. have been above the Canadian rates for about 3 years now, which is the longest span in about 25 years. That may crisscross here in the next month.
All right, well, it gives us something to watch here. Scott, final question. CPI and PPI later this week. How big of an impact could that have? I mean, in theory, you're talking about these fluid numbers. Those are numbers, again, that are going to be watched as well.
Huge. You know, when you break it down, all of these numbers, even the jobs report last week, it's just one number. However, with the pressure that the economy is under right now, the pressure that the Fed is under right now, every single one of these major economic data points, jobs, CPI, PPI, certainly are going to play into their decision of what they do a couple weeks from now.